Ladies and gentlemen, Archivist here. If you are watching this, you possess a sensing mechanism that most of the population lacks. You feel the tremors before the earthquake hits. You understand that the official narrative regarding the global economy is not just flawed. It is a carefully constructed veil designed to keep you calm while the building burns. Today, we are going to tear that veil down. We are going to look at a dataset so alarming, so undeniable, that it redefines the timeline for the next global conflict. Stop looking at the distraction theater. Stop obsessing over the performative military exercises in the Taiwan Strait or the diplomatic handshakes in San Francisco. Those are designed to be seen. Those are the magic tricks intended to draw your eye away from the real action. If you truly want to know the intent of a superpower, if you want to know if Beijing is preparing for a kinetic war that will shatter the global order, you do not look at their tanks, you look at their bank accounts, you look at the movement of sovereign debt. Debt is the lifeblood of the empire. It is the bedrock upon which the entire post-1945 order was built. It is heavy, it is cumbersome, and it is incredibly slow to move. You cannot liquidate a trillion-dollar position in an afternoon without crashing the global financial system. It takes months, sometimes years, of methodical, quiet selling to offload significant positions. And when the second largest economy on Earth, the factory of the world, begins to dump the debt of its primary rival at a speed that defies all economic logic, they are not simply rebalancing a portfolio. They are clearing the decks for war. They are severing the financial arteries that have bound the East and West together for 40 years. We need to conduct a forensic deep dive into the data released by the US Treasury Department this week. The Treasury International Capital, TIC report is often ignored by the mainstream media because it is dense, boring, and complex. But we don't skim headlines, we read the footnotes. And the footnotes confirm a trend that Wall Street is terrified to admit. China's official holdings of US Treasury bonds have collapsed to $688 billion as of October 2025. Let that number sink in. $688 billion. To the average person, that sounds like an astronomical amount of money. And it is. But in the context of the financial marriage between the United States and China, this number represents a catastrophic divorce. This is the lowest level of Chinese ownership since May 2009. Think about where you were in 2009. The world was a different place. We have effectively erased 16 years of financial integration in a matter of months. To fully grasp the magnitude of this exit, we must look back at the peak of Chimerica, that symbiotic economic relationship where China produced and America consumed. In 2013, Beijing held $1.32 trillion in U.S. debt. They were the banker to the American dream. They bought the bonds that kept U.S. interest rates artificially low, allowing American consumers to buy cheap Chinese goods on credit. It was a perfect, closed loop of capital flow. China exported deflation. America exported inflation. That loop is now irrevocably broken. China has liquidated nearly 48% of their position from the peak. They have sold off over $600 billion worth of American IOUs. But here's the detail that the pundits on CNBC are missing. It is not just how much they sold, it is when and how they sold it. Throughout late 2024 and all of 2025, the U.S. bond market was in a historic drawdown. Interest rates were volatile, spiking to levels not seen in decades. In the bond world, when yields rise, prices crash. This means that anyone selling US Treasuries during this specific window was selling at a massive realized loss. In the world of professional asset management, rule number one is you do not sell a depreciated asset for a loss unless you absolutely have to. You hold it to maturity to get your principal back. You only sell at a loss if you're facing a liquidity crisis, meaning you're broke and need cash immediately to keep the lights on, or if you believe the asset is about to become toxic, worth zero. We know China is not broke. Despite the collapse of Evergrande and their domestic real estate struggles, China continues to run a massive, historic trade surplus with the rest of the world. They are swimming in cash. Their factories are still humming, churning out the electric vehicles, solar panels, and batteries that the world demands. So, if they aren't selling because they need the cash, why are they taking billions of dollars in losses to exit the US bond market? The only logical conclusion, the only one that fits the data points we are seeing, is that the Chinese Communist Party has made a strategic, existential decision. They no longer view the US Treasury bond as a risk-free store of value. They view it as a strategic liability. They view it as a trap. This is not an economic decision. This is a sanction evasion signal. We must view this through the lens of February 2022. When Russia invaded Ukraine, the Western powers, the United States and the European Union, executed a financial maneuver that shocked Beijing to its core. Overnight, with a few keystrokes, they froze $300 billion of the Russian central bank's foreign exchange reserves. These were funds sitting in safe Western accounts in New York, London, and Brussels. Russia thought this money was untouchable sovereign property. They were wrong. It was seized, immobilized, and effectively rendered useless. Beijing watched this unfold in real time. They analyzed it. They wargamed it. They realized a terrifying truth. If we make a move on Taiwan, or if the friction in the South China Sea escalates into a hot war, our US Treasury holdings are not an asset. They are a hostage. The $688 billion they still hold is effectively a prepaid donation to the US Department of Justice, waiting to be seized. The moment the first missile flies, or the moment a blockade is announced, that money goes to zero. It becomes a frozen number on a screen that they can never access. So, they are getting out. They are liquidating the position with extreme prejudice. They have calculated that taking a 10%, 20%, or even 30% haircut on the face value of the bonds today is infinitely better than risking a 100% total loss tomorrow. This is a strategic fire sale. It is the financial equivalent of a burn notice. They are dismantling the great wall of debt that stabilized the US economy for 20 years, and they are doing it with a velocity that suggests they believe the window of opportunity is closing fast. Usually, when a central bank wants to rebalance its reserves, it does so quietly. It sells slowly, in small chunks, over years, to avoid spooking the market and driving the price down against itself. But the velocity of the recent drop, shedding nearly $12 billion in October alone and hundreds of billions over the last year, suggests Beijing is less concerned with market stability and more concerned with capital flight. They want the money out of US jurisdiction, and they want it out now. This mass exodus has profound implications for the US economy, and by extension, for your personal financial survival. For 2 decades, the US government has enjoyed a unique privilege. It could run massive, irresponsible deficits because there was always a price-insensitive buyer in the East. China would buy the debt regardless of the yield because they needed to recycle their trade surplus dollars. They didn't care if the interest rate was 1% or 5%. They just needed a place to park the cash. That buyer is gone. The great enabler of US fiscal irresponsibility has left the building. China has turned from the biggest buyer into the biggest seller. This creates a massive supply-demand imbalance in the US bond market. Think about it like this. If the biggest customer at your store suddenly starts dumping all the products they bought from you back onto the street at a discount, what happens to the value of your inventory? It crashes. Who is going to buy the debt that China is dumping? Who is going to fund the US deficit now? As we will see in the next section, the burden is falling on a group I call the Bag Holder Alliance. The US is forcing its allies, specifically the UK, Europe, and Japan, to cannibalize their own economies to keep the US financial system afloat. But this artificial support system has a breaking point, and we are dangerously close to finding out where it is. If the first act of this drama was the Great Exit by China, the second act is the Great Conscription of the West. When a $688 billion hole is blown into the side of the US bond market, someone has to fill it. If that hole is left unplugged, interest rates wouldn't just rise, they would explode. Mortgage rates would hit double digits overnight. The value of every pension fund in America would collapse, and the US government would be unable to service its own debt without printing money into hyperinflation. So, who stepped in? Who caught the falling knife? We need to look closely at the who in the tech data. While the line item for China is plummeting towards $600 billion, other line items are spiking to historically abnormal, almost suspicious levels. Specifically, we are looking at the United Kingdom and Belgium. Let's look at the numbers. The United Kingdom's holdings of US debt have surged to record highs, reaching over $750 billion in late 2025. This puts the UK neck and neck with China as the second largest foreign creditor to the United States after Japan. Think about the absurdity of that for a second. The UK economy is roughly 1/6 the size of China's economy. The UK does not run a massive trade surplus. In fact, Britain runs a persistent structural trade deficit. They import more than they export. So, ask yourself, where is Britain getting the spare cash to buy nearly $750 billion of US debt? They aren't buying it with excess profits like China did in the 2000s. They don't have excess profits. They are likely buying it with borrowed money or through complex financial engineering centered in the City of London. The UK is effectively leveraging its own fragile balance sheet to act as a shock absorber for the US Treasury market. They are taking on debt to buy our debt. It is a financial Ouroboros, a snake eating its own tail. Then there is Belgium. In the latest data, Belgium's holdings are sitting between $320 and $370 billion. Is the Belgian government suddenly flushed with cash? Is Brussels running a massive surplus? No. Belgium is home to Euroclear. Euroclear is one of the world's largest international central securities depositories, ICSD. It is the plumbing of the global financial system. When you see Belgium buying US debt in the T-key report, it is rarely the Belgian government buying for its own reserves. It is a proxy. It is a mask. It is often other central banks, sovereign wealth funds, or custodial accounts trying to hide their activity. It creates a layer of anonymity. However, the timing tells us everything we need to know. The surge in Belgium and UK holdings is occurring exactly in sync with China's selling. This is not a coincidence. This is a coordinated effort by the G7 nations. This is what I call the bag holder alliance. This is not a free market decision. Why would a rational investor in London or Brussels aggressively buy US Treasuries right now? The US is running a $2 trillion annual deficit during peacetime. Inflation is sticky and refusing to drop to 2%. The US dollar is being weaponized against nuclear powers. Buying US debt right now is, objectively, a risky trade with a terrible real return. The fact that the Allies are loading up on it suggests geopolitical arm twisting. Washington is effectively telling its partners in London, Brussels, and Tokyo, China is dumping. We are in an economic war. If you don't step in and absorb the supply, the US bond market breaks. If the US bond market breaks, the global dollar system breaks, and we can't protect you militarily or financially. It is a form of financial conscription. The West is being forced to cannibalize its own economies to keep the US financial system afloat. But this strategy has a fatal flaw: capacity. China had a seemingly infinite capacity to buy debt because they were the smart factory of the world. They earned real dollars by selling real goods: shoes, phones, cars, solar panels. Their wealth was derived from production. The UK and Europe do not have that capacity. They are deindustrializing. They are struggling with their own debt burdens, slow growth, and expensive energy transitions. By forcing them to buy US Treasuries, Washington is draining the liquidity from its own allies. It is weakening the periphery to save the core. This creates a system that is incredibly fragile. If the UK economy stumbles, as we saw during the LDI pension crisis in 2022, they might be forced to sell those treasuries to raise cash to save themselves. If that happens, the bid of last resort disappears. China knows this. This is the Sun Tzu aspect of the economic war. China is playing a game of attrition. They are bleeding the West dry. Every $1 billion of bonds they dump forces the Western financial system to find $1 billion of liquidity to buy it. It draws capital away from productive investments, like building factories, upgrading grids, or researching new tech, and sucks it into the black hole of refinancing US government debt. It is a weaponized sell-off designed to exhaust the financial capacity of the G7 before the kinetic conflict even begins. Furthermore, this shift changes the fundamental nature of the US bond market. It used to be a market dominated by economic buyers, China, Saudi Arabia, emerging markets, who bought for profit, trade, and currency stabilization. Now, it is a market dominated by political buyers, the UK, Belgium, Japan, who buy for diplomatic survival. Political buyers are fickle. They buy until their own voters revolt. They buy until their own currency crashes. We are watching the transition of the US Treasury from a global reserve asset to a NATO reserve asset. The market is shrinking. The pool of willing buyers is getting smaller, while the issuance of debt, the supply, is getting larger every single day. And while the West is busy shuffling these paper liabilities among themselves, desperately trying to keep the yields down, China is doing something very different. They are taking the cash from these sales and running to the one place the US Treasury cannot touch, sanction, or freeze: the physical world. When China sells a US Treasury bond, the transaction settles in US dollars. The People's Bank of China, PBOC, receives a digital credit in a custodial account, but they don't keep it there. As we established in Part 1, they view digital dollars as a trap. So, what are they doing with the proceeds of this massive $700 billion exit? They aren't buying euros. They aren't buying yen. They are engaging in the most aggressive rapid commodity accumulation drive in modern history. They are converting paper claims into physical reality. We need to stop looking at stock tickers and start tracking the cargo ships entering the ports of Qingdao, Shanghai, and Tianjin. While Western analysts debate whether the Fed will cut rates by 25 basis points, Chinese state-owned enterprises are swallowing record amounts of raw materials. This is not a commercial inventory build for iPhone production. This is a strategic hoarding campaign for survival. So, where is the liquidity from these bond sales going? The answer lies in 4 essential pillars of the real economy: gold, energy, industry, and food. 1. The golden pivot. The people. As Bank of China, PBOC, has emerged as a relentless buyer of gold. While official reports confirm consecutive months of net buying, actual transactions via the Shanghai Gold Exchange suggest volumes may be higher. This shift from treasury bonds to physical gold indicates a move to minimize counterparty risk and reduce reliance on international settlement systems. They are pivoting from credit-based reserves to collateral-based reserves. 2. Energy security. Crude oil. With oil import dependency at approximately 70%, energy security is a top priority. Data indicates that strategic reserves are being filled to near capacity, estimated at 1.5 billion barrels. The massive construction of storage infrastructure suggests long-term preparation for potential supply chain disruptions. 3. Industrial resources. Copper and minerals. Despite a slowdown in the domestic real estate sector, China's imports of copper and strategic minerals remain at record highs. This points to a structural shift toward high-tech industries, green energy grids, and EV manufacturing. They are securing critical inputs for the future economy rather than holding financial derivatives. 4. The food fortress. Holding roughly 20% of global GDP, but only 7% of arable land, China has accumulated massive grain reserves, estimated by the USDA at 60,070% of global corn and wheat stocks. This strategy trades financial yield for food security stability. We are witnessing a paradigm shift from return on investment, ROI, to return on security. Accepting financial losses on paper assets to acquire real assets is not short-term thinking. It is a strategic hedge against inflation and geopolitical friction. For individual investors, the traditional 60-40 portfolio may need reevaluation as bonds lose their status as the ultimate safe haven. So, how do you position yourself for a world where the biggest buyer leaves the market? You follow the Archivist's protocol. Protocol Rule 1, shorten your duration. If you must hold government paper, you must understand duration risk. Duration is a measure of how sensitive a bond's price is to interest rates. Long-term bonds, 20-year, 30-year Treasuries, have high duration. If interest rates rise by 1%, the price of a 30-year bond can crash by 20%. As China exits, the structural pressure on long-term rates is upward. Even if the Fed cuts short-term rates, the long end of the curve, which is determined by supply and demand, not the Fed, is vulnerable to a buyer strike. If China sells and the UK taps out, yields must rise to attract new buyers. Rising yields mean crashing prices for existing bondholders. Therefore, do not hold long-term US government bonds or ETFs like TLT. These are the assets most vulnerable to the Chinese sell-off. If you want safety and yield, keep your cash in short-term T-bills, 1 month to 6 months. Short-term bills have almost zero duration risk. They are less sensitive to geopolitical dumping. They act as cash equivalents. Be like China, get liquid, get short-term. Don't lock your money up for 30 years with a government that is fighting an economic war it cannot afford. Protocol Rule 2. Follow the smart money, hard assets. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This is not just about profit, it is about inflation protection. Think about the end game here. If China dumps $688 billion and the Allies eventually stop buying, who buys the debt? The Federal Reserve. The Fed will have to step in as the buyer of last resort, yield curve control. They will have to print trillions of dollars to monetize the debt. When they print trillions, the value of the dollar falls, and the price of stuff goes up. This is the inflationary loop. China knows this. That's why they are buying the stuff now, before the printing press goes into overdrive. You should own the producers of these assets. If China is hoarding copper, you want to own the miners that produce copper, companies like Freeport-McMoRan or Southern Copper. If China is hoarding oil, you want to own the energy producers, like Exxon or Chevron. If China is hoarding gold, you want to own the metal itself or the royalty companies. These assets act as a hedge against the debasement of the currency. You want to own the stuff, not the currency that buys the stuff. Protocol Rule 3. Watch the allies. You need a warning signal. You need to know when the bag holder alliance is breaking. Monitor the currencies of the key US allies, specifically the British pound, GBP, and the Japanese yen, JPY. These countries are straining their own resources to support the dollar bond market. Japan, in particular, is the canary in the coal mine. They are the largest holder of US debt, but Japan is fighting a currency crisis. The yen has been volatile. If Japan has to intervene to save the yen, they will have to sell US Treasuries to get the cash to buy their own currency. If Japan joins China in selling, it is game over for low rates. Watch the USD-JPY exchange rate. If the yen crashes towards 160 or 170, or if Japanese bond yields spike, it means the bag holder alliance is fracturing. That is the moment the US Federal Reserve will be forced to intervene. That is the moment the pivot happens. Not because inflation is beaten, but because the Treasury market is broken. The $688 billion figure is not just a statistic in a government report. It is a countdown clock. China is methodically, deliberately removing itself from the US financial system. They are clearing the decks. They are willing to take a loss today to ensure survival tomorrow. Do not interpret the current stability of the market as safety. It is an artificial stability propped up by political pressure and borrowed money. When that prop gives way, the adjustment will be violent. Get out of long-term debt. Get into hard assets. Watch the flows. The divorce is finalized. We are just waiting for the house to be sold. This is Archivist. The protocol is active.